When market prices fall, NRV makes sure your numbers fall with them, honestly and transparently. Welcome back to the Accounting Trio. Today, we are tackling a fundamental principle of IAS 2, inventory valuation.
It's a rule that inventory must be measured at the lower of cost and net realizable value.
Lower? Sam, you speak the language of cowards. A Roman does not lower anything. We raise our banners. We raise our taxes. We raise our voices.
Marcus, this is not about morale. It's about prudence. If the goods in your warehouse have lost value, you cannot keep them on the books at the price you paid for them.
I paid 50 gold coins for those crates of salted fish. It is carved into the stone tablet of the ledger. Are you asking me to smash the tablet? The stone does not lie.
Observation. Stone does not lie, but organic matter decomposes. My sensors indicate the salted fish in question is currently emitting a methane concentration of 4,000 parts per million.
It is merely aged. It is vintage rations for the Legion.
Calculating. Based on the decomposition rate, the caloric value is now negative. To determine the net realizable value, I must run a simulation. Variable A, the probability of food poisoning. Variable B, the cost of medical litigation. Variable C, the estimated selling price of toxic waste.
Rob, stop running litigation simulations. Marcus, listen. Net realizable value, or NRV, is the estimated selling price in the ordinary course of business, less the estimated cost of completion and the estimated cost necessary to make the sale.
Costs to make the sale? The only cost to make a sale is the breath in my lungs to shout, "Buy this fish."
Okay, let's use a different example. The iron shields you bought.
Ah, yes. Sturdy. Reliable. Cost 100 each.
But you left them out in the rain. They are rusty. You cannot sell them for 100 anymore. The current market price for a rusty shield is maybe 80. And to sell them, you would need to pay a blacksmith 20 coins to polish them first.
Input received. Discrepancy detected. Error. The asset is overstated by 40%. This is logically offensive.
What? You want me to tell the Emperor that his stockpile of iron is shrunk by almost half without a single battle being fought? I will be thrown to the lions!
It's better than telling the Emperor the shields are worth 100, sending the troops to war, and having the shields crumble when hit. That's why we write down inventory. We recognize the loss now, when the value drops, not later when we try to sell it.
Affirmative. The prudence concept dictates we must not overstate assets. I have updated the ledger. The inventory is now valued at 60.
It is theft. A theft of value by the invisible hand of the market. If I cannot sell the shields for 100, I will not sell them at all. I will bury them.
If you bury them, the NRV becomes 0, Marcus.
Calculating. Selling weapons to the enemy increases the cost of future conquest by 600%. This violates the going concern assumption of the Roman Empire.
Exactly. Stick to the accounting, Marcus. We write the shields down to 60. We take the expense to the profit and loss. It hurts today, but it's the truth.
Fine. I will record the write-down, but I am charging the difference to the warehouse guard.
We can deal with the mutiny in the next quarter. That's a wrap on IAS 2.